As human beings, those part of the trend tend to last quite longer than expected. When we think about US equities, who would have told us in 2012 or 13 that would be in a 9 years long expansion, would have been the first to doubt about it.
Right, yeah.
And at a point, therefore, we don't want to be too reactive in terms of money management. We want to stay in for the longest possible part of that convergent phase.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kostrup Larsen.
Hey everyone, and welcome to another edition of Top Traders Unplugged, where today my co-host Moritz Seibert and I are joined by Jean Jacques Duhot, who is the founder and CIO at Arctic Blue, which is part of the $15 plus H2O asset management group. Now, JJ, thanks so much for coming on the podcast with Moritz and me today. We really appreciate you taking time out to do this, and we're very excited about our conversation today. Now, there is an interesting story behind your firm and your journey in particular, and the question of why you created the strategy the way you did. So why don't we start with that? Tell us about your journey and what you've been up to in all these years.
Well, thank you first to having me, both of you. I'm extremely honored to be part of this podcast that I've been listening for many years now.
Thanks.
The journey of Arctic Blue started in Canada when I moved to the Great North in 2007 to join the Sovereign Pension Fund of Quebec. And we developed, implemented systematic strategy with a specific approach by asset class, taking into account the panel of market participants and their specificities. In Arctic Blue, the name came from the fact that one day a friend of mine was working for administration of Canada, and we end up in Nunavut, which is north of Quebec, with a cargo plane, and temperature was around minus 43, and I just land. It was pretty cold, and the sky was extremely blue. And there was a sign with the distance to the polar cycle. And I thought that if one day I'm creating my own fund, I will look at a name like Arctic Blue. And at the same time, the logo we use, which is an Inukshuk, which is that man made of stone, and it's a directional marker in the Great North built by the Inuit population. And for us being directional traders, I thought it was maybe also a good complement to the story.
Yeah, no, absolutely. Very interesting. I mean, for me at least, the whole structure and how you've used the background that you have, in terms of creating your strategy, thinking about what it is you want to achieve is quite unique. I've not really come across that before. Why don't you take us back a little bit in terms of your professional background and how that influenced you in creating the strategy and the philosophy behind it, perhaps?
Well, I started my career at Société Générale, and I stayed there for a bit more than 10 years. And around 1997, I start to manage a group of proprietary traders, taking a risk myself, and analyzing their performance and their P&Ls. I start to sit close to them, taking notes about their behavior. And I was interested by human reaction regarding risk-taking. And risk-taking in a different trading environment, different volatility regime. Is this trader is patient, impatient? Is it rigorous in terms of risk? Is it reactive? Is it opportunistic? And we learn great lessons by people making money in a consistent basis, but also the ones that are losing money in a consistent basis. And I thought that at a point, I developed sometimes some frustration around some seasonal patterns in banks where you start to be asked to reduce your risk exposure around October, November, quite famous bonus time those days, and where a lot of opportunities in the marketplace could not be captured by people like us. So I start to read a lot about a firm I think you know well, Niels, Den Capital Corp and John Henry and
Sure.
really the Turtles and all the legend, amazing individuals that gave birth to our industry. Yeah. And I thought that trend following was an amazing part of the story, but maybe it could be complemented by some contrarian approach, and also taking the trend by cutting it in two parts, like breakout at the beginning, then trend, then contrarian, and all the chain of those different phases in the momentum cycle were relating about the impact of a new information hitting the price and creating a different type of positioning by market participants. And I thought that when a new information is hitting the price, it tends to create a surprise effect, and the market goes from a very precarious equilibrium to an unbalanced distribution in the price action, to then reach a point where, or it could be a maximum favorable excursion, or it could just mean revert. And that first part being very impulsive, I guess that would have need to developed a systematic trader that would be very reactive at entry and very opportunistic at money management level. You know very quickly if you're wrong, and therefore you have tight stop losses, and you have a multiple array of profit taking depending on the shape of the expansion. And then the market tend to pause, and you end up having a second type of crowd coming in, some second layer of human beings keen to take risk. As the information is more analyzed, accepted, and you observe more of a convergence type of price action where that information is becoming really concentrated. And you are moving from a game of reactivity in the first phase to a game of patience. As human beings, those part of the trend tend to last quite longer than expected. When we think about US equities, who would have told us in 2012 or 13 that would be in a 9 years long expansion, I would have been the first to doubt about it.
Yeah.
And at a point, therefore, we don't want to be too reactive in terms of money management. We want to stay in for the longest possible part of that convergent phase, to the point where that information is becoming so well known in public media and completely over-consensual that you need to then think about introducing a third class of market players that are the contrarians, and playing on the exhaustion of that momentum. And you end up having three groups. You have your very reactive traders, you have your very patient traders, and you have your contrarian traders, and you want to empower them by giving them the same level of risk and being totally independent from each other and not talking to each other, which I think was also an interesting point. In some firm where I've been operating, you end up having quite a significant correlation risk between discretionary traders, as they tend to talk to each other, feel good about it, and you end up having some potential risk of max peak to valley drawdown on that front.
Yeah,
a firm where I've had the chance to manage capital for Millennium Capital Management. At Millennium, we were not very encouraged to talk to each other in order to be sure that their low correlation between the team was maintained. And I think today they have more than 200 investment teams, and it's a very successful firm on that front. So really keeping that independence for each model, with each of them arrive their own risk, and you end up back to our beginning of the journey, creating that desk of automated traders with their independence under the supervision of another set of algorithms that are the risk manager. in order to avoid correlation and concentration risk. So that's really more of an empirical analysis at the beginning of human behavior regarding risk-taking and market price action compared with some other systematic funds that have more a pure statistical analysis that we use, but at a later stage.
Yeah. I'm interested, so when you did the initial analysis and you're making your notes about these traders, were there more of a certain kind of traders, meaning are discretionary traders, do they tend to be more contrarian or mean reverting? Because I'm thinking that finding discretionary traders that have the mindset of being a trend follower is perhaps more rare than it is for someone who will take the profits quicker and so on and so forth.
You're absolutely right. Really, on that point, I could not add anything else because I agree 100%. But back to the early part of your question, what was striking was the inability for a very large percentage of them not to take their losses very quickly, but more try to average by being incremental when momentum was against their initial position, and not what some trend followers doing, which is adding when the momentum tend to be in the favor of the position.
Yeah. You know, there's this famous line by Paul Tudor Jones, which says, "Losers average losers." I think that's what you're describing, right? So you're in a loss-making position, and then you average your price by buying more on the way down. Yeah. Not a good idea in general.
No. I mean, another thing that is striking to me when I was preparing for our conversation today is that, so obviously you thought about the system design very differently, which is intriguing. But I also thought your choice of playground, so to speak, the markets you decided to trade. I'd love to hear the background of that, because it's an unusual portfolio to some extent in our space.
Yes, so as I joined the Sovereign Pension Fund of Quebec in Canada, due to the very large portfolio and multi-assets that they were managing, I thought that an approach by asset class was making sense. And digging into that early observation of the portfolio, I found that the commodity traders tend to be very different from the market participant in equity market. When you look at commodities, you have on one side the producer and the consumers, the Starbucks versus the Brazilian coffee producers on one side that come to the marketplace to guarantee themselves a price to buy or to sell the stuff they need. And on the other side, you tend to have people like us with some financial techniques, with a potential asymmetry in our favor to harvest those insurance premium wrote by the commercials. But when you look at the dynamic between commodities and the overall asset class, you tend most of the time to pay to wait, i.e. you cannot apply traditional cash flow analysis such as in real estate or equity or fixed income, where you get paid to wait via dividend, rents, or coupons. And therefore, I think it was important to take a very agnostic type of view of that playground and equi-allocated risk for breakout, trend, and contrarian models as weather, supply disruption, geopolitics tend to send very little warning for abrupt of the direction of prices in commodity space. So that was really that approach for commodities and looking at what were the most liquid market and the correlation between them, between different complex and intra-complexes. And that was really the approach for commodities. And then we applied the same for fixed income, where so an approach by silo, where in fixed income, you still have a momentum engine, but the curve is a very important component, and therefore deploying models specifically designed for curves. And for currencies, same momentum engine, but specific models developed for carry on a 30 pair of currencies, including emerging, and a carry model with money management around it in a dynamic way, instead of having those classic carry models that tend to just benefit from the interest rates differential, but all of a sudden try to have significant max peak to value drawdown. And then in the equity space, you end up having a bias to be long of equities. And we see those distribution of momentum that tend to last longer than in other asset classes when they are free to evolve, I would say, so which is a bit different than since 2008 when you look at fixed income with QE analysis. But and you look at equity from corporate buyback to 401k to large sovereign pension fund of Nordic or Middle Eastern countries or Japan that are very large buyers of equities, making the overall float less and less ample, I would say. And all the merger acquisition also on top of this. And therefore, if you want to bring an atypical type of proposal in the equity space, we have been taking an approach where we would overweight the contrarian bias in order to bring cover, if I may use the term, to long equity or long-short type of portfolio in case you're exposed to dislocations such as in August 2007, for example. So it was really taking into account the nature of the panel of market participants in each asset class by not tweaking the model, but just applying the model with the same type of input, but with different weights based on the nature of the underlying momentum and what is the purpose of your strategy in order to avoid to purely deliver beta in phase like we've known over the past few years.
Yeah. How many markets do you actually have in the portfolio?
So in the commodity market, we have 20 markets, and that's a specific product that is available in different type of formats. In equity, we have 60 different markets, and so on. So it's really segregated. We do not offer, like most firms, a 4 asset class product.
Right. Interesting.
I saw in your presentation that you're focused on commodities, and I saw the energies in there and a few others, but a relatively small portfolio, correct me if I'm wrong, but maybe 10 markets or something like that. Is there a reason for that? And what impact does that have on your diversification, which I guess you're seeking to maximize?
Sure. So we are trading a 20 different market in the commodity space with a significant representation in terms of numbers in ags.
So that's expanded over time, the number of markets? Have you always done that actually?
Yes, because we basically used to trade ags as a basket, and we trade grains, soft, meats, and cotton individually. And then in the energy space, we're trading the main markets. What has been for us important is taking into account the correlation risk. And we tend to find that we extract very little diversification from the barrel when you look at the different product. And in terms of risk-reward, mainly Sortino ratio, we thought that it was a less attractive proposal for us. We tend to be mid to long-term, lower frequency, selective into our participation. And if you want to go even further about that, we may be doing something different, but I guess everybody you're interviewing,
they will always say that they do something different. That's true.
We're a binary. So we really look at being in or out, but we are not incremental, even when momentum is positive. So the full amount of risk would be deployed at inception of the position when the signal has been cleared by some signal-to-noise ratio filter. And also, when we are looking at how also different we can be looked at, we have that specific approach by asset class, which I think also make us slightly different. And those independent model having the ability to participate at different locations through the momentum cycle in terms of trade positioning, so that give us at least a low correlation with most of our peers.
Very interesting. Thank you. One other thing, if I may, that I found interesting was that most of the markets you're trading as futures, and then there have been a couple of products where you, for instance, you don't trade the gold futures, you trade GLD. At least we found that in one of the presentations. Is there a reason why you're doing that? Why you prefer the ETF as opposed to the futures markets?
Well, the ETF tend to have two specificities. So we are trading futures in one program. We are trading in ETF in the other program. ETF is clearly not that efficient in terms of funding, so that's the first negative point. But on the positive side, we found that the ETF market is reflecting really a participation of investors in gold without the noise of the short-term high-frequency trading during night session mainly, and in a very noisy markets such as gold, and mainly since 2013, where we did not observe the same type of distribution of directional opportunities than in the 20 years pre-2013. We found that the quality of the signal was quite higher through the ETF. And also you think that the ETF is being backed by physical, which is quite a bit different than the futures, where there's always this mystery about the number of claims versus the effective amount of gold available. But I don't want to sound like a gold bug here.
Interesting. And then there were two other interesting markets I found in the portfolio next to the commodities, which was the VIX index and the US dollar index.
Yeah. So the dollar index, obviously nearly 58% of euros as we speak, tend to capture the dynamic of the correlation between the dollar and commodities, which through the time is not always as stable as we think it is. So it acts as an alpha generation via a currency hedge, even if dollar index is treated in the same way than the other markets. So that's the presence of the dollar index. And now the VIX, well, the VIX has been there because we could not identify the liquid volatility future of commodities. And we looked at what is the largest asset class in the world with a liquid volatility instrument listed. And we found that the VIX was acting as a good warning signal on one side, a carry generation on the other side. But as our input take into account price, implied volatility, realized volatility, and we do not trade options, we do thought that the VIX was a good complement by, in a way, trading volatility as a sub-asset class.
Have you seen changes in the VIX actually after XIV disappeared? Have you noticed some changes? Yeah.
Yes, because we have two types of models. We have the models that we take position with, that we described before, and on the other side we have filters, and those filters are analyzing relationship between different type of volatility, and we've been more and more filtered out of the VIX market.
Right. Interesting.
And it's interesting because when you look at when that episode of dislocation happened at the beginning of the year, you look that the VIX has bottomed in November 2017 just with a print sub 9, and it's then start to really increase until that quite volatile episode. And since then, never revisited those low levels. So for us, November 17, there's an inflection point in the market. So you could look at the VIX correlation with the 5-year, 30-year spread in U.S. Treasury. You could look at where we are in the cycle with the Fed. You could look at the trade war today. You could look at geopolitical tensions, but there's clearly an inflection point in market behavior around that date that has been reflected by the VIX.
Yeah, I mean, my observations seem to be that not only has the volume dropped since XIV sort of lost all their money, so to speak, but also there's just fewer people who are willing to sell at the very low level. So as you say, the bottom of the VIX seems to have gone up a little bit compared to last year. Interesting. I wanted to ask you a little bit more about the commodity side. So traditional trend following systems, and it may not apply to the way you do it, but my experience is that we tend to make more money on the upside. So we tend to make more money from the long side trades compared to the short side trades. I'm interested in finding out whether you have the same experience with the way you trade commodities, and also whether maybe part of the struggle for CTAs in recent years may come from the fact that we've been in, generally down markets or bear markets for many commodities. So perhaps opportunities have been harder to capture. Have you thought about this? Have you noticed this? Have you,
I think we've made more money being short commodities than being long on our side, mainly due to the contrarian models.
Right, of course.
Which makes sense.
Yeah.
What we've been observing is lower participation in the market, very large fundamental discretionary hedge fund that have exited the playground. Also inflows that were behind a commodity rise from early 2000 to 2008, 2010 was pension fund money and commodity indexed money that was protecting against inflation and also benefiting from the thematic of Chinese infrastructure development.
Yeah.
And since we've observed those very low and sticky low inflation level, that money is not as aggressive and is not as part of the asset allocation. It used to be the case pre-2008. And so therefore, we've seen some markets offering better diversification at market level. I think that when you look at the price action of indices such as the Bloomberg Commodity Index or the GSCI, they are trending quite less. There's less correlation between commodities than when the commodity index was dominating the price action in the first part of the 2000 years. And therefore, the market are more back to their fundamentals. I'm thinking about sugar.
Right.
Where we had amazing range from 11 to 24, back to 11 now. Over the past few days in sugar. And that has been a very generous market with us. Some markets have structurally changed. I'm thinking about natural gas in the US. It's a market that used to trade in back month $20 when you take into account of the roll pre-2008. And with the technology based on the extraction of shale gas, we've seen a market ranging between high twos and low fours dollars. So it's a price divided by nearly 5 or even more. And that also made the mid to long-term directional opportunities less easy to catch in this market. So there has been a redistribution generally, and commodities are exhibiting more of a sort of individual type of behavior with some successes and some disappointment too.
Right. But more divergence in general in those markets, it sounds like.
Yeah, definitely. Yeah. And a very high concentration of volatility in some market, like the meats, for example. On the other side, you have a structural phenomenon of the very depressed prices for agriculture, and when you look for the past 40 years, the overall price of agriculture has been quite mind-boggling for a lot of people based on all the long-term positioning due to demographics, growing demand, evolution of food habits in the world. And when you look at what happened in terms of prices, at least on U.S. commodity futures in the agricultural sector, it's been quite the opposite. Yeah. And we saw those prices really going lower and lower and lower. If you look at the DBA, for example, as a basket of agricultural futures, we saw we are trading at all-time lows.
Right. That's the ETF you mentioned.
Yeah. Yes, and that's all-time lows. Yeah. We're on a $16 handle. And that therefore, I think that there's amazing gains of production in the US.
Right.
The farmers have been the first benefiting from US banks to get cheap money lended to them. And they made tremendous gains in
technology and productivity.
Absolutely, and therefore the supply is quite ample.
Yeah, right. So it sounds like that the concept of your strategy obviously took time to essentially formulate it from all the observations you talked about and so on and so forth. And I know I'm not phrasing it correctly, but it seems to me that you're sticking with your methodology. You don't really change it. You don't, and there is this debate which I find interesting, and that is the question. Should we adapt our models to changing environment, because clearly the environment, as you suggest, do change, or should we stay with a relatively unchanged approach to trading? Where do you stand on that, and what have you done inside your own strategy when it comes to adapting it?
So the approach stay unchanged, and the bulk of the research, except the very classic execution tools and their efficiencies, and it's been really all about money management and risk approach with an ability to look at the position sizing, the evolution of the position sizing, the allocation through the different markets, and the ability to filter ourselves out of some very noisy episodes, and always trying to find the right balance. I think we did a fair job in some markets. I'm thinking about crude oil, where the distribution on the upside looks very obvious when you look at a graph. But as a participant, I think it's been quite more challenging. Setbacks were quite violent. Sure. And in some other market, our presence has naturally been smaller and smaller. And I'm thinking one more time about nat gas.
Right.
So it's been really getting a higher reactivity and at the same time a higher filtering based on the price distribution, if we are in or if we are out of the market. And therefore it's been more the money management part of the algorithm that has been covering the bulk of the research, as well as an emphasis put on an additional model brought to the arsenal, if I may use the term, which is the short-term reversal model.
Okay. I know you've got some questions, Moritz, but I wanted just to finish off on this topic, because I think when you talk, there's always something new that I want to ask you. And one thing that springs to mind was what you mentioned earlier about when you get in full and you stay invested full until the signal change. I find that really interesting. And so I'd love for you to explain why you find that to be advantageous for your approach. And also I'm wondering a little bit when it comes to capacity. I mean, commodities, of course, in itself has lower capacity than many of the financial markets. But also then adding on top of that, trading the full size might actually limit the capacity in some ways, because you're dependent a little bit more on liquidity in a certain time when you want to trade without incurring too much slippage, compared to getting in slowly, getting out slowly, if I can put it like that. What are your thoughts about that? Why do you find that the way you do it suits your objective, so to speak?
In terms of the different facilities offered by the exchanges, if we go into the nitty-gritty of it, you have a trading asset element like TAS, which are offering you a very good amount of liquidity with a minimum slippage. If you're considering that the closing price give you the validation of a midterm pattern, that makes your slippage for the more classics model being not an issue. Okay. Now, stop entry on some contrarian models need indeed to have a very low footprint, and that's been part of the research around the implementation of those triggers, taking into account the volume. So do you spread the volume on several maturities? Do you intervene at different times? So a lot of research has been put on the distribution of the volume intraday around market on open, market on close, TAS, block trades. That I think give you an interesting new dimension versus the very traditional volume and open interest type of analysis.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.